At retirement in Ireland, you face one of the biggest financial decisions of your entire life. You spent 30 or 40 years building up a pension pot, and now the question becomes, do you buy an annuity or an approved retirement fund, or ARF? It's a one-time decision that could shape your entire financial future. It will determine how much income you have in retirement, how much flexibility that you keep over your money, how much or anything that you can potentially leave to your family, and how much tax that you will ultimately pay. There's a lot riding on this decision because once you choose, there is no going back. In this video, we're going to cover what annuities and ARFs are and how they work in Ireland. We'll look at a break-even analysis where one option starts to outperform the other, the trade-off between security and growth, and the legacy implications many retirees overlook. And then, to make it all real, we'll work through a real Irish example. By the end of this video, you'll understand the trade-offs, the numbers, and the risks so that you can make the right decision with confidence. Now, let's look at the retirement fork in the road. When you retire with a defined contribution pension in Ireland, the key decision is what to do with the balance of your pot. And this is where the fork in the road appears. One option is to buy an annuity. That means you swap your pot for a guaranteed income for life. The other option is to transfer it into an ARF or approved retirement fund. Here, your pot stays invested. You draw down income with flexibility over time. But here's what makes this decision so significant. You cannot do both with the same money. Once you buy an annuity, there is no going back. And once you've moved into an ARF, your pot stays exposed to the markets for better or for worse. With an annuity, you trade ownership for certainty. You hand your pot over to an insurer, and in return you get income that you cannot outlive. But once you die, unless you pay extra for guarantees for a spouse pension, the money is gone. With an ARF, you keep ownership and flexibility. The money stays invested so it has the chance to grow, but it can also shrink. You can pass it on to your spouse or your children when you pass away, but there is no lifetime guarantee. Draw too much, or if markets hit poor timing, you could run out of money. This fork in the road is permanent. And these two paths suit very different types of retirees. Those who value certainty and don't want to manage investments, and those who want flexibility, growth potential, and the ability to leave something behind. Understanding the fork in the road is the foundation for every decision that now follows. So now, let's look in detail at the first option, the annuity. At its core, an annuity is very simple. You hand your pension pot to an insurance company, and in return, they promise to pay you a guaranteed income for life. It's a straight swap. You give them capital, they give you certainty. Now let's look at the advantages. The first is that guaranteed of income. You cannot outlive it. Whether you live to 75 or 105, the payments will continue. The second is simplicity. Once it's set up, there is no more investment management, no market monitoring, no portfolio reviews. Your income just arrives in your bank account. The third is peace of mind. There is no risk of running out of money. This is especially valuable for those who have very little income outside of the state pension. There's also add-ons that you can pay for. A joint life annuity, so your spouse keeps an income if you so happen to die. A guaranteed period, so payments continue for 5 or 10 years even if you pass away early. Or escalation, where your income rises by say 2 or 3% each year to offset inflation. But remember, every extra reduces the starting income that you will receive. Now the downsides. First, poor value if you die early. If you die within the first 4 years of retirement, you may only get back a fraction of what you've put in. Unless you pay for extras, the insurer keeps the balance. Second is inflation risk. Most Irish annuities are fixed. This means your income stays the same even while the cost of living may rise. Over a 25-year period, inflation can quietly erode nearly half of your spending power. Third is no flexibility. Once purchased, an annuity cannot be changed. You cannot increase or decrease withdrawals to match your needs. And finally, no inheritance. Unless you've added spouse or guaranteed options, the income dies with you. There is no residual funds for your children. So why do annuity rates seem so low in Ireland? There are 4 main reasons, and the first is interest rates. Annuities are backed mainly by government bonds, and for nearly 2 decades, Eurozone rates have been close to zero. Low bond yields mean low annuity payouts. Even after recent ECB rises, Irish annuities still pay around 4 to 5% for a 65-year-old. The second is longevity. We are living longer. A 65-year-old today can expect to live in their mid-80s or possibly even to their 90s. The longer you live, the more years the insurer must stretch your pot out to pay. That reduces the annual payout. The third, inflation protection is expensive. You can buy an annuity that rises with inflation, but the starting income is typically 30 to 40% lower than a fixed annuity. Most people don't take it, so the real spending power declines over time. And finally, it's the insurer's margin. Insurance companies build in cushions for certainty and for their profit. It also reduces what you see as your income. For example, take a €100,000 pension pot at age 65 without any extras and after any tax-free lump sum. A typical annuity may give you around $3,900 to $4,500 per year. Compared to the 1980s when rates were close to 10%, the difference is stark. That's the annuity. It delivers certainty, but at the cost of flexibility, growth, and inheritance. Now, let's look at where the ARF comes in. An ARF works very differently from an annuity. Instead of handing over your pension pot to the insurer, you keep it. The money stays invested in funds, ETFs, or managed portfolios, and you decide how much income to draw each year. Let's look at some of the key features. The first is you retain ownership. Your pension pot is still your asset. It doesn't disappear into an insurance company. The second is growth potential. Because the money stays invested, it has a chance to compound over decades. If markets perform well, your pot may even grow while you're still drawing down. The third is legacy. An ARF doesn't die with you. If you pass away, the balance can transfer to your spouse tax-free or to your children taxed, but still the wealth preserved within your family. Now for the downsides. First, there's market risk. Your ARF is exposed to investment volatility. Markets rise and markets fall, and your income depends on how your pot weathers those changes. Second is withdrawal risk. If you take too much out too quickly, or if markets fall badly in the early years, you could run out of money before the end of your life. Third, the minimum withdrawal rates. From age 61, you must take 4% each year. From age 71, it rises to 5%. And if your total pension exceeds $2 million, the rate is 6%. That means even if you want to preserve the capital, you cannot leave it untouched. And finally is management. Unlike annuity, an ARF needs ongoing oversight. You need an investment strategy, an annual review, and the discipline to adjust withdrawals as conditions change. So that's the ARF. Its growth, its control, its inheritance potential, but there are many risks attached. The real test between them is not what they earn, it's about how they perform over time. So let's put them side by side with a worked example, and we'll see which one pulls ahead of the other. So how do annuities and ARFs actually stack up in practice? The best way to look at this is through a break-even analysis. That means asking which one begins to outperform the other. What happens if you live longer than expected, and what's left behind you if you pass away early? Let's use a realistic Irish example. A retiree at 65 has €300,000 in their pension pot. Option 1 is the annuity. They buy a single life annuity with a 2% escalation. The rate is 4.13% for a 65-year-old woman. The income starts at $12,390 per year. Remember, it'll rise by 2% each year. By age 90, it pays over $20,000 per year. Remember, that income is guaranteed for life. But there is no balance left at death. Option 2 is a ARF. They keep €300,000 in the ARF. The money stays invested in a balanced portfolio. We assume about a 5% net annual growth before tax. Withdrawals follow the revenue minimum rules. Remember, 4% from 61 and 5% from 71. So at age 65, withdrawals are about €12,000 per year. These withdrawals rise gradually over time, and the pot itself remains intact, still around $318,000 at age 90. Now let's see how this plays out side by side. By age 70, the annuity has paid out €64,000 cumulatively. The ARF has paid out $60,000 cumulatively, with the balance unchanged. By age 75, the annuity has paid out $139,000 in total. The ARF has paid out $120,000, but the ARF balance is still $318,000. By age 80, the annuity has paid out $220,000 in total, and the ARF has paid out $200,000, but there is still $318,000 in the ARF. By age 90, the annuity has paid out $340,000 in total income. The ARF has paid out $320,000, but crucially, the ARF still holds $318,000 in the pot. Remember, the annuity income is guaranteed and it rises with inflation protection, but it leaves nothing behind. The ARF income is based on minimum withdrawals. If your goal is not to leave money behind, you could take much higher withdrawals from your ARF. You could double the income in early retirement, though this will shrink your pot much faster. So the ARF gives you choice. Take more now and spend it all, or take the minimums and preserve capital for your heirs. If you die early, the ARF clearly wins. If you live a very, very long life, say to 95 plus, the annuity may catch up because it keeps paying no matter what age you reach. But that only happens if markets underperform. Otherwise, the ARF usually delivers more flexibility and gives you the legacy. So side by side, the ARF tends to leave you better off unless you live a very long life and you're unfortunate with market performance. But before you rush to a conclusion, there's another factor that can tilt the balance, and that is tax. On the surface, annuities and ARFs look the same for tax. Both are treated as income. Taxed at 20% or 40% income tax, plus USC and maybe PRSI. But the real difference isn't the rate of tax, it's the control you have over and when you pay that tax. With an annuity, your income is fixed. Pays $12,000 a year, that's added to your taxable income every single year. You can't adjust it, you can't reduce it, you can't even defer it. So when the state pension kicks in at age 66, your lower tax band begins to fill up pretty quickly. And more of your annuity income is pushed to the higher tax band at 40%. With an ARF, withdrawals are also taxed as income, but you can control the income. You can withdraw more before the state pension begins, filling the 20% back, then scale back later once the pension arrives. Revenue does impose minimums, remember 4% from age 61, 5% from 71. But even with those rules, an ARF gives you more flexibility. And tax is only part of the picture. Now let's talk about growth and inheritance. With an annuity, once you hand over your pot, it stops growing. Your income is guaranteed but fixed, and it usually dies with you. You can pay in extra for spouse and guaranteed options, but every extra that you purchase reduces your starting income. With an ARF, your pot stays invested. It can compound over decades, and if you die, the balance remains with your estate. It can transfer tax-free to your spouse or to your children tax, but still preserves the wealth. Let's look at our €300,000 example again. With annuity, you'd get about $12,000 a year or $340,000 over 25 years, but nothing is left at death. With an ARF, you could take the same income, but at age 90, you'd still have around $318,000 left for your spouse or children. So ARFs just don't give you flexibility on tax. They also give you growth potential and the ability to leave a legacy behind you. The choice between an annuity and an ARF isn't about which one is better, it's about which one is better for you. And that depends on your income needs, your tolerance for risk, and your family goals. So let's start with annuities. An annuity is usually best for people who want absolute certainty. It suits those that are risk averse. If the idea of market swings keeps you awake at night, an annuity will give you peace of mind. For those with little secure income outside of the state pension, an annuity can create your own private state pension. People that are expecting to live long lives, an annuity could potentially end up paying out more than your original pot. Now let's look at the ARF. An ARF is best for those who value flexibility and control. It suits those who are comfortable with investment. If you understand that markets can go up and down and you can easily ride out those dips, the ARF lets compounding work for you. Those who have other pensions and income outside of the state pension, the ARF gives you more freedom. Third is families who care about legacy. An ARF remains in your estate. You can pass it on to your spouse tax-free or to your children taxed, but still remains in preserved wealth. And people who want flexibility, with an ARF, you can adjust withdrawals. Take more in the early active years, scale back later. With an annuity, you are locked into the same payment for life. So, should you take your pension as an annuity or an ARF? The truth is, no one-size-fits-all answer. If you value simplicity and security above all else, and you're less concerned about leaving money behind, then your annuity may give you the peace of mind that you're looking for. But if you value flexibility, control, and the ability to grow and pass on your wealth, then an ARF usually makes more sense, especially today with annuity rates near historical lows. Now, in most cases, this is an either-or decision. You must choose one path for a given pot. But if you have more than one pension pot, you could choose one as an annuity and the other as an ARF. Here is the most important point. The decision is irreversible. Once you annuitize, you cannot go back. That's why it's critical to run the numbers for your situation before you commit, because the right choice doesn't depend on averages or on what your neighbor did. It depends on your age, your health, your family goals, and your tax position. This is exactly the type of modeling that I do with clients. We compare annuity and the ARF side by side. We run break-even analysis, we stress test for market shocks and for longevity, and we factor in tax and inheritance, so that you can make the decisions with clarity, not guesswork. If that sounds useful, you can book a discovery call with me using the link below. The goal is to give you confidence in one of the biggest financial decisions in your entire life. And if you found this breakdown helpful, the next video will look at the optimal withdrawal strategy for your ARF. We'll explore the bucket strategy and how to structure your withdrawals so that you're more resistant to big market swings, and how to enjoy a less stressful retirement while making your ARF last longer.